Hello, everybody. I'm Jerry Kronenberg, Director of Financial Content here at Moomoo Technologies Inc., and I'd like to welcome you to a very special webinar with a very special guest, the one, the only, Stephen Sarge Guilfoyle. Steve is our new markets commentator here at Moomoo Technologies. You can check him out every day on the Moo community at Invest with Sarge, S-A-R-G. Steve is a former floor trader of the New York Stock Exchange, at the New York Stock Exchange for Credit Suisse and others, a former staff economist, and a current columnist for TheStreet.com Pro. Welcome, Steve.
Hey, I'm glad to be here. Thank you for having me, Jerry. Thank you, Moomoo.
Great. It's great to have Steve here. He will be answering your questions every day at Invest with Sarge, his account on the Moo community. That's S-A-R-G. He is a former sergeant of the United States military. And Steve will be joining us to take some questions live now. As a reminder, this is an interactive webinar, so I'd like to encourage everybody to submit some questions. If you give us a completed question during this video, we'll give you 100 Moo points just for doing so. And if we use the question live on the air here, we'll give you 1,000. And Steve will try to answer a few of these during the week at Invest with Sarge, so check him out every day. Now, the topic of the day is options, which Steve is very well versed at. We're going to ask him some questions about that. Before we get started, while we wait for some questions to come in, Steve, let's talk a little bit about options for people like me who haven't really traded them. Just in a nutshell, what are options? How do they fit into an investment plan? Why do you use them? Give us the 411 on that.
A lot of folks, they get a little scared if they're new to trading and investing. They become intimidated, I think, by options. I've had so many people that were excellent equity retail traders, and every time I try to get them involved and take them to the next level and get them involved in options, they've always said, I'm not ready for that. I'm not ready for that. So really, it's a matter of becoming comfortable. And options are really, quite simply, it's a right. It's a right to buy or sell a stock or any underlying security at a certain strike price by a certain expiration date. I mean, if you think about it, options are worked into almost every deal that's executed in American business across the entire country, or really globally, anywhere business is done. So why not here? Why not at the retail level with stocks? This is how people like us do business.
Great, excellent. Let's talk about a really basic options trade. One I've even thought about doing, but have not, which is a covered call. What is that, and how does that work?
That's probably the closest thing to riskless that there is in our universe. A covered call is simply the selling of a call in a stock or an underlying security where you already own 100 shares of that stock. Because one options contract is worth 100 shares. So if you own 80 shares of something, of McDonald's hamburgers or any stock, no, you can't sell covered calls against that because you need to have 100 shares. So part of that call, if you sold a call, would be naked, which comes with a lot of risk if you want to get into naked options. I don't know if you want to do that. But covered calls, if you own 100 shares of a stock and you sell one options call contract against that position for a premium, you can consistently, if it works over time, roll it over, drive down your net basis, or what some of you call your average price for that stock over time before it takes off and eventually gets to your strike price or your target price. Now, if it goes above the strike price, it's called a call because those shares can be called away from you by the other side of the options trade. So if you bought the stock shares at 95 and you sold a covered call at $100 with a $100 strike price, and it goes up to 105, you're still selling it at 100. The other trader, the other side of the options trade, gets the rest of that profit, but you still got your target price. And let's say you sold it for $2. So you didn't buy it at 95 and sell it at 100. You bought it at 93 and you sold it at 100 for tax purposes and that sort of thing.
Okay, and so the risk there is that you are risking some potential, or one of the risks is that you're risking some potential upside. So you bought the stock, as you said, at 95. You wrote your call at $100 strike price. Yes, that's correct. And it goes to $200. You've lost all that upside between $100 and $200. So that's one of the key risks.
The cost is just opportunity risk. Yes, it's not actual risk to principal. You're still at equity risk. You still have that downside risk, but the option does not create any increased risk to your principal on a covered call.
Okay, that sounds great. All right, let's start with some questions. While we wait for a few more to come in, let's start with some we got ahead of this video. First one is from Sean Parker. Is it safer to go with a call or a put option to minimize loss? What is the best for first-time buyers? What are your thoughts on that, Steve? Of course, you can't give exact recommendations to people, but in general, what are your thoughts on that?
Well, I don't think it's automatically safer to go with a call or a put in order to minimize loss. It depends greatly on whether one is buying calls or buying puts, or selling calls or selling puts. Obviously, buying options comes with a downside risk to the price the premium that you paid. You might lose that money. But when you're selling calls or puts and you don't have an equity position against that, this is what we call naked selling of calls and puts. There's almost infinite risk on this, because if it goes against you the wrong way, it can go all the way down to zero. It can go all the way up to infinity on the upside. You can get hurt either way if you're selling calls or puts without any kind of equity position against it. So obviously, that's not something I don't think we want anybody to do who's just learning about options, who's just starting to get in the game. I think we want you to go in a different direction. I prefer to start out with new people buying rather than selling, because I think selling is scarier than buying. I think being short is scarier than being long. So we start out with just maybe a call in a stock you're comfortable with. You don't have to have an underlying position if you just buy a call, because the only downside risk is the premium paid. And as we get further along, we can explain how to turn that into a spread, which further decreases the risk, but at the expense of capping profitability.
All right, great. We're starting to get some questions in, but let's take another one that we got ahead of this broadcast. Good question here. How do you blend technical and fundamental analysis when evaluating options? Discuss how these approaches can assist us to make better trading decisions. Great question there. What are your thoughts there?
Yeah, this is almost one of my favorite questions to answer for anyone, whether you're trading equities, options, or hubcaps. I don't care what you're trading. But I really feel that fundamental analysis is important, technical analysis is important, and economic analysis is important. I think there are three disciplines involved in trading and in investing more than trading. And I think a lot of new traders get caught up not getting past one or two of these disciplines, and moving on to becoming a more complete investor because maybe they have some initial success in one. Usually it's technical analysis. Usually new first timers or new guys, new kids, they get involved in technical analysis because it's the easiest of the three to master, and you can have immediate success with it on the short term. So let's say you're a day trader. If you're day trading, you might not need more than technical analysis. But if you are a more serious investor over time, you're going to need to learn how companies work. Whether you're trading options or equity, you need to know whether this company is actually running a well-run business, whether they have the sales growth, the cash flows, the balance sheet that you want to see, all these kinds of things. So you have to know your way around fundamental analysis, and you also have to understand economics. You have to be able to front-run policy. You have to think ahead of central bankers and legislators. So you need to understand which direction you think the macro is going, because that gives you a leg up on the policymakers, because they're almost historically slow to act. So you can think a little bit ahead of them. So I think there are three disciplines. I think you need all three. Very short-term traders might get away with just technical analysis, but everyone, I think, who's going to trade longer term needs all three. Think of it this way. Let's expound on this just a little bit. Think of the market or as a bus. Okay, the macroeconomic analysis is the direction the bus will move, because that creates policy. So the bus is either going to move north or south. It's a north or south road. Then we move on to fundamental analysis. This tells you whether the stock you're picking is in shape to keep up with the market trend. So is it going to keep up with the other buses on the highway? That's fundamental analysis. Technical analysis tells you where the bus stops are. It tells you what price levels are likely to meet more resistance or more support, less resistance, less support. It gives you a better idea where this bus is going to pull over, where it might make a U-turn, those type of things. So if you think about it as a moving vehicle, hopefully that helps.
Okay, that's great. Let's take one more from our earlier questions, and we'll go to some live ones. This is from user Wonder. How much profitability in percentage terms do most traders look at before considering closing out on an options trade? For a seller who's deep out of the money options, seller of deep out of the money options, with still a long date to expiry, is it better to close out with a profit and take up a new position, or should you let that option expire and get maximum profits? Thoughts on that one, Steve?
Well, this is really a matter of preference, and I cannot speak for everyone, but I can tell you what I do. Uh, I tend to look at the chart of the stock, not the option, because in percentage terms, options can go up or down hundreds of percents in no time. So I tend to look at the stock. I tend to pick my target prices, my panic points, my add points, and my pivots all on the stock and act accordingly in the options. As far as time decay, if let's say you're running an option strategy, it's based on a lack of volatility. So you want to see some time decay here. You sold an option at $2 or $3, you want it to go zero. And that option goes down to like 10 or 25 cents quickly. And there's still a lot of time left until your expiration. Well, if you've already made 80 or 90% of your money, of your potential profit on this sale, why would you risk all that profit just to try to maximize over the next week or two until expiration? So I do think if you've already made most of the money you can make, it is probably wiser in most instances to get this trade off of your blotter and just take your profit.
Okay, great. Now we've got a question from a live viewer here. While we can't give exact advice, the question is, I foresee the S&P 500 going down. Besides buying puts, are there some other options that I can perform, reduce risk and cost? So any thoughts on that in general terms?
Well, there is a Fed meeting tomorrow, and a lot of folks are buying puts ahead of that. I've seen this trend this yesterday anyway. I saw it. And I expect to probably see a little more of it today. I think that some folks are a little bit afraid of a short-term fall if the press conference doesn't go. I wouldn't say it doesn't go as planned, or if Powell, due to the recent increase in inflationary data, feels forced to open up his options going forward, because right now the market believes he's only looking at when he's going to cut. If he is to jawbone, the probability of, let's say, a one-time 25 basis point increase into the Fed's fund rate back into the marketplace, yeah, you could probably see the market have a nasty fall if tomorrow's dot plot and tomorrow's press conference don't go as well as they could. So your thinking is probably right here. But as far as buying puts, how should I put this? I think it's prudent, but it increases your net basis, if you know what I'm talking about. Before I spoke of net basis and reducing your average price on a long position, if you're buying puts, you are increasing your net basis on that position. So I'm much slower to buy puts if I don't have a short position against it than I am to sell options if I do have some kind of equity against it. So I wouldn't say I would encourage wholesale activity as far as this goes. But if you are nervous about a position and you think that the short-term events of this week could go against you, then it does make sense to sell a put or puts that would protect you. But also think about putting on a lower, buy a call lower, so maybe you can extract some capital if there's a fall, but it also reduces the expense of the puts you buy.
Right. And just a reminder, Steve cannot give exact advice on all sectors. So
I'm not giving exact advice. I'm just saying what I think I might do.
Here's another one where the person is asking for a specific recommendation, but you give them some general thoughts. What type of stop loss is best to use with options? What are some things that might go into making that decision, Steve?
I don't think I've ever used a stop loss order on an option. I think I tend to watch the options. When I have an options trade on that I'm actually actively trading, that's not just a hedge against an equity position or just I throw it out there and hope it gets there. I think I tend to actively watch options when I have them running in short-term trading, in day trading, let's say. As far as stop loss, I think they make sense for equities when there's a large amount of capital involved. I prefer to use mental stops. Maybe that's just old school of me. I don't like to put it down on paper or put it down so my broker can pick up on it. That's probably just because I come from the old days when it was actually humans trading, and I don't want other people to know what I'm doing. So I do use mental stops far more than I use actual stop loss orders. But I mean, but it does make sense. If you do something else occupationally, I should stress that I trade these markets and I invest in these markets occupationally. If you're doing something else with the productive hours of your day because your occupation is unrelated to this field, well, then it probably does make sense to place stop orders, but know where your exit point is, know where your panic point is. I think it's so important for traders to know their target, to know their panic points. We call them panic points, but they're anything but, because what they do is you know where you're willing to sell the stock or buy a short back. You know where your panic point is, which takes emotion completely out of the equation. Now you're acting like a robot, and you won't trick yourself into increasing your position at a discount just because you're trying to defend what you've done.
All right, great. Let's take a few questions that we got ahead of this, and then we'll go back to some live ones. This is a good one. What markets or trends are suitable for an option strategy versus the traditional buy low, sell high strategy? One of my favorites. What are your thoughts on that?
Well, I don't know if there really is a market trend where options trading would be useless. Selling naked puts is obviously dangerous. If a market is running, let's say if a market is moving within a trend, with an upward or downward trend, then obviously if you're doing something like selling calls against a bull market or selling puts against a bear market, even if you are hedged by an equity position, you're probably going to run out of equity pretty quick. So I don't think you really want to do that. So we go back to selling covered calls, which allows ones to sell a long stock to reduce net basis, but you will get paid a higher premium if a market is moving in a trend like that, because on one side of the market anyway, because the algorithms, which now control price discovery for the most part, will be pricing in the higher probability that call is actually exercised. So it is this is actually a more difficult question to answer than you think, but I think the best trend for trading option strategies is probably a market that is not very volatile, a market that is moving sideways, and that way if we get advanced, you can sell, you can get short strategies like iron condors, iron butterflies, things like that, which tend to protect you from a rapid increase in volatility, but you'll also profit from a lack of volatility.
Okay, great. And another one, this is a good one. What factors affect options pricing? What are your thoughts on that?
Well, let's see here, because I wrote this one down. Except when external forces such as gamma get involved, because that involves a third party really. Options pricing equals the strike price relative to the share price and time premium or time until expiration. All right, gamma is a fancy word, like I just said, but it's really the speed and the change in the delta, and it forces market makers to take an equity position as their options position grows exponentially larger and more quickly than they expected. That's why you hear the term gamma squeeze sometimes with the meme stocks a couple of years ago and stuff like that. When a stock that obviously shouldn't be valued where it is just runs wildly. So yeah, gamma impacts a small number of stocks in a big way, but otherwise you're really just talking about the underlying security. You're talking about time premium versus time decay, things like that. The rest of it is really risk management. And now that so many, even options and equities are priced by algorithms more than humans, really the emotional quotient has been taken out of it. So it's a very robotic process now. So I think you can probably just watch it for a while. Whatever stock you're trading or whatever options of whatever stock you're trading, watch it for a while, see how it goes. Don't jump into something because you read it on Twitter or you read it on Moomoo, and it's the hot name right now. Be slow. Remember, slow is fast, fast is smooth. That's really how you have to think about this.
Great point. Now we got a very technical question, but I'm sure you can handle it. What delta and DTE, which is days to expiration, should I use for maximum theta gain? So this person's obviously quite experienced. Any thoughts on that, Steve?
Well, theta tells you how much the price of an option should decrease each day as it nears expiration versus uh, in theory, on average, if a stock, let's say a call option goes down 35 cents versus the dollar decline in the value of the equity, that's a theta of 0.35. So it is a very technical question. I think what this trader is asking is what kinds of strategies are best for benefiting from the erosion of theta over the life of that option. I think the trader wants to get paid a premium and then see all options evolve in the strategy expire worthless. So I think we go back to the iron condors and the iron butterflies, and I think you want to be short those kinds of strategies in this example. I don't think this example works so well if in a wildly volatile stock like Supermicrocomputer or Nvidia or one of these stocks that's heavily engaged in whatever the theme of the day is, and today's theme is AI. So I think these are probably better strategies for like industrials. I wouldn't say utilities because you don't need something that dead, but industrials or discretionary, something like that. I don't think this is really something unless you're really a gambler, that you want to play the tech game in.
All right, great. Here's a live question from user Paul Sayao, if I'm pronouncing it correctly. All right, a little bit too specific, but maybe you can give some general thoughts. So, when do you place a leap option, and if it moves up more than 100%, you take profit even though the option has more than a year before it expires? So again, we can't get into a specific recommendation, but can you speak in general about leaps, and again about when to take profits when you're positive versus.
Did he say he was buying leaps or selling leaps?
He said placing a leap.
Okay.
So take the best stab at that one.
Yeah, it's going to be expensive. It's going to be expensive because they're so far out. Sometimes it makes sense to sell a leap at a distant expiration if you really believe that the stock price is never going to get there, and just try to capture the premium. But if the stock shows any volatility at all and you're nowhere near to that expiration date, that can become quite costly quite quickly. I won't say never trade leaps, but I will say it's not something I've made a habit of.
Okay, great. Here's another one. I guess we may have talked about this a little bit, and again, we can't give you direct advice, folks, on best, but question is, what's the best strategy to use when selling options? So you want to talk about maybe some general thoughts on that, Steve?
Well, if you want to sell options, I mean, like the safest one is the covered call, which we covered at the top of the show.
Mm-hmm.
And the opposite of that would be a covered or protective put against a short position. So I mean, those are probably the two safest ways to go with this. Otherwise, if you're selling, like I do this myself, to be honest with you. I mean, I'll sell puts at levels of stocks that I want to buy, but not at the prices they trade at now. So while there is a risk there, it's a risk that, based on the charts and your understanding of that stock, you're willing to pay for. Let's say you have some stock that's trading at $50, but man, if it ever got back to $38, you would love to buy some of that. Well, see if the premium for the $38 puts out another 3 months, like around next reporting season, are paying enough premium for you to take that chance. And if let's say the premium is $3, well, even if you get hit at 38, even if the shares are put to you, that's why we call it a put, well, then your net basis, your average price is going to be 35 rather than 38, even if you bought it at 38. So even if you get tagged at 38, you paid 35, in some cases, you can sell it below where you technically bought the equity because of the premium that you took in on the sale. So I think those are cases where I, being an experienced trader, am willing to take a risk in stocks that I am no longer in, or I wish I was in, that I missed the move. And I think there's a technical reason for it to stop or come close to stopping at a certain level. I'm willing to open myself up to equity risk over time at that level and get paid to do so.
Okay, great. Now here's an interesting one that I'm always interested in. So is choosing the earnings calendar or economic events for picking the price and date for options a better strategy than ignoring delta, IV, et cetera? So that's interesting because, of course, we see a lot of options volatility around earnings. Do you use earnings calendar and economic events for picking the price and date of options, or is that a better strategy? And should you use that and ignore such things as delta IV and the like?
I don't
Any
think
thoughts on that?
I don't think anything you understand how it works and it makes sense. I don't think you should ignore, but it does make sense, in my opinion, to try to time your options trading with things like earnings, with things like elections, with things like events such as FOMC policy meetings, or whatever country, whatever nation you might be in, the central bank policy meeting of the economic system that you live in. So I think that events really matter. I don't like I said, I don't really like to go that far out on earnings before. So usually 3 months is probably my max for how far I'll go out on, and that's usually around earning times for a stock that I wish I played better this season. I'll go out around their next earnings release, which is usually 3 months later, and try to set myself up for where I think the stock might be trading at around that time, so that I won't miss it twice in a row.
All right, great. Here's a live one for you, and it's a good one. For investors seeking long-term stock holdings, how can you utilize options to enhance profitability while mitigating risk exposure? Any thoughts on that, Steve?
Well, I mean, I know a lot of people talk about dollar cost averaging. I like to do a version of that, not true dollar cost averaging where it's just set over time and it doesn't matter where the stock is trading. But I like to. I mean, I would name a couple of stocks for you. I'm kind of doing it with now, but I don't know if I'm allowed to on the show. But there are a couple of stocks.
Stick to general. Yep.
Yeah, there are a couple of stocks right now that I am accumulating on dips. I'm building large positions on these stocks. One of them is an AI stock. One of them is a financial. And I think that they're undervalued going forward. Maybe not undervalued in today's money, but I think both of them are well intertwined with the future of finance, the future of artificial intelligence and defense, and those types of issues, and undervalued relative to that future. So even if it's above my net basis, because usually when I buy stocks, I try not to violate net basis, which is my average price point of entry. But on these stocks, given they're not really expensive stocks right now, basically anytime there's a serious down day, I'm not talking about a nickel or a dime, but anytime there's a down day where they're giving up, 7 or 8 or 10%, I am adding to those positions. So I do that through the equity market largely, but you can certainly do that the way I explained in my previous answer, where you sell puts at levels you want to buy the stock, and you get paid to wait. And maybe it never gets there. Maybe you never buy it, but at least you took in that premium, and maybe it does get there. And if you just bought it there because it dipped, or if you bought it there because you got hit on a put that you had sold, at least the guy who sold the put got paid.
Great. All right, we got time for one more question, and a good one it is. How do you decide the expiry date of options to trade? Of course, if you look at the different options available, there are many different expiration dates. Talk about what thinking processes go into deciding an expiration date for a trade.
Like we said before, the earnings release of a stock matters greatly to me. I prefer to trade the monthly options because there's usually greater liquidity in a given stock's monthly options than there are in their weekly options. As far as daily, 0 days to expiration options, which don't trade in everything, but I think they trade in some ETFs. I tend to stay away from those because those are more a function of day trading, and really, until folks get a handle on which way the flow is going in those options during the day, which they can do, it's really, if you get involved in those types of options early in the day, it's really just gambling. So I try to stay away from that. I've only dabbled in it, but really around corporate events or around policy or government events such as an election, if you think there are two candidates for an important role in your government and they both have drastically different opinions on what direction the economy should go in, that would matter greatly in how you would time your options.
All right, great. That's all the time we have today, Steve. Thank you. And he will try to answer some questions. If you want to check him out on the Moomoo community and invest with Sarge, Sarge. Thank you for watching. I am Jerry Kronenberg. For all the best news and information on stocks, check out the Moomoo app every day. and check out Invest with Sarge on the Moomoo community. Stephen, thank you for joining us today, and thanks to everybody for watching.